In this video, I'm going to be giving you my 4-step framework to buy dips at a very high probability. A big problem that most beginners in crypto have is that they see a dip, but they don't really know how to take advantage of it. How low is it going to go? Where exactly am I supposed to enter? How exactly am I supposed to enter? What time frame am I supposed to use for this? In this video, I'm going to break down this very beginner-friendly and also proven framework that I and my students have used to grow their account by anywhere between 3 to 5x using this exact framework 2 to 3 times a year. And regardless of when you're watching this, as long as we're still in this bull run, this source is going to help you out immensely and is very likely going to print some free money for you. So guys, going to drop a lot of value. All I ask is that you listen in because this is going to be the sauce. Let's get into it. 2024 was a bit of a rough year with some ups and downs, quite literally. The first quarter and the fourth quarter were ups, and the second and third quarters were downs. Now this year is likely going to shape up quite similarly to 2024, with Q1, as I would predict it, to be an up quarter before getting some kind of consolidation. Now I don't know what this year is going to bring us, but there is a pretty high likelihood that the ups and downs of last year are going to be continued on in this year. Only this time around, we're going to have some kind of a blow off top, probably closer to the end of the year. Although, again, it's a bit too early to speak right now, so I'm not going to talk too much more about that. And what I want to talk about though, and something that's going to be much more relevant to you than what's going to happen in Q4, is what's going to happen now. Like, what do you need to know right now to be able to take advantage of the plays in crypto? Currently, the reason why I'm saying that this one's going to be a pretty quick video comes down to one thing, which is the playbook that I have for buying dips. And currently, a lot of these conditions for buying dips in a bull run have been, well, let's just say complete. Now, the first thing that you want to look for is some kind of a 50% to 80% retracement from the highs. On Solana, which is a very big cap coin, you're not going to see as high of that kind of retracement because currently it's only down about 33.5%. But if you go onto just any old random coin, for example, Lock-in, this thing's much lower in market cap and you're down about 80% from the high. Even if you were to go onto a semi, large cap coin, but not as strong as Solana, boom, that's 50%. So that's the range that we're working with. And by the way, if you ever see another 50 to 80% retracement on crypto, again, just understand that the last time this happened, you literally got a 3 to 5x/10x on pretty much anything that you bought. For example, over here, you went from $200 to $100 over the course of 4 months. And the moment you get close to like a 50% retracement, boom. Obviously, this is just the first criteria that you want to look at. I'm going to give you the other confluences in a bit. But instantly, this is Solana. This is the number 3 largest cap cryptocurrency, period. So we can just look at something else that's a bit more random, ideally something that's a bit smaller. So there you go, 60% retracement, which ultimately leads to, even if you don't buy from the bottom, you're still going to be up, well, that's 250%. So guys, that's rule number 1, or like criteria number 1 of how to buy dips during a bull run at a very high probability. This, by the way, is the playbook that I myself use to catch essentially just free 5 to 10x's throughout the course of a bull run. This is what I teach inside the AOC Alpha group as well. And this is the source essentially. It's simple. It's a very proven framework that quite literally anyone can follow. So rule number 2 is going to be to never catch falling knives. Now, catching falling knives usually feels like the most exciting and the most right thing to do for about a few hours, and then you're going to instantly regret your decision. Why? Because when price is going straight down, there is quite literally zero indication that tells you that price is just going to bounce straight away. And a lot of people tend to buy catch the falling knives in hopes that they will catch the bottom and price is just going to do a V-shaped recovery. And yet, I can tell you with confidence that 99% of people that try to do this tends to get stopped out and they end up losing most of their money. Like, for example, they buy into here thinking it's going to be the bottom, they lose the trade, okay, boom, they're going to try it again over here because they see that, oh, it's strong support, right? Well, nope. They buy it here on very high leverage thinking it's the bottom, boom, price goes slower. And eventually, when price actually does make the bottom, 2 things happen. One, they are already so traumatized by the amount of losses that they took on at this stage here to where they don't even dare to buy in anymore because somehow the lower the price goes, the more afraid people get, and the more afraid people get, well, they don't really pull the trigger, when you should be doing quite literally the opposite, because in order to achieve minority results, you need to be doing minority actions. And the majority of people, when price is going straight down, the majority of people aren't going to buy. And so guess what happens when you buy? But point aside, the second thing that happens is that they lose all of their money. By the time the bottom does come around, their account is already down 50%, or they've already put all of their money fully allocated into areas like this. They do not have any more free capital to buy. My favorite saying about, not cashing falling knives is, firstly, the worst position to be in when the market is in a dip is to lose all your money through liquidations, which happens when you try to catch falling knives. But the second thing that the second worst scenario or position to be in when the market is dipping is to be in a position where you are sidelined and unable to get in because you do not have enough capital to allocate. This happens when you buy everything up here and you no longer have any free capital to buy anything down here. This is the generational entry, not this. If you never want to get into that kind of situation, avoid catching falling knives. Again, it feels really exciting to do for about a few hours or a few minutes for some people, and then you're instantly going to regret your decision. It's much better to follow this framework, which is waiting for high volatility to low volatility. Now, essentially, what this means is that after following every period of high volatility, which means price moving straight up or straight down, you tend to go into periods of low volatility, such as this. Now, this is what you want to go for. So instead of catching falling knives, where trust me, you are never too late to the party. Even if you miss the exact bottom, the chances of you catching that exact bottom in the first place is so low that you're probably going to lose everything before you get there. And so the better move is to wait for a confirmation that the trend is changing, which means confirmation that price is now changing from downtrend to now uptrend. That will be the highest or easiest proven framework to buy dips. So the first thing you want to look for when it comes to that is for price to go from high volatility to low volatility, right? This happens all the time. Price goes from high volatility, all right, guess what? It starts slowing down, perhaps even starts forming a range after high volatility. Boom, okay, it starts shopping around for a bit. Boom, all right, starts shopping around for a bit before boom, right? The reason why this happened, I'm not going to get into the reason why this happens, but just understand that the markets always oscillate between high volatility to low volatility. This is the third criteria you want to look for. And the fourth criteria is that ideally these fit. In fact, this should honestly be a part of first criteria, which is that your 50 to 80% retracement should lead to a liquidity sweep or a PD array. So a liquidity sweep is essentially just any old swing high, swing low. So for example, this is a swing low here. The moment price takes out this low, this is considered a sell-side liquidity sweep. So in that 50 to 80% retracement, ideally you want to see some kind of liquidity sweep. For example here, Bitcoin recently just swept the liquidity down here and it's currently pumping. Now, Bitcoin does not fall under that 50 to 80% line though, so I'm not going to consider that. Popcat is a good example. So Popcat recently went through a retracement of more than 50%, so that's 70%, and at its low, not only did it hit a previous daily support resistance line, but it also took out liquidity at this level. So Popcat at the moment seems to be an insane candidate for these criteria. Now, the next one is ideally you want some kind of PD array fill. What's a PD array? Well, a PD array can be a golden pocket of the Fibonacci. So in this case, price filled the 0.618 and the 0.705 and eventually came down to the 4-hourly 200 EMA. In fact, I believe this is the daily 200 EMA. Yes, it is. That is a daily 200 EMA. So just any sort of other confluence, right? It could be a daily support resistance line. It could be a previous resistance tended to support. Could be a liquidity level. It could be just anything as long as there is some kind of confluence around those levels that line up with a 50 to 80% retracement that goes from high volatility to low volatility. And now this is the final stage of the playbook, which is currently happening on the markets right now. So I hope you guys take this playbook and run with it, because this is going to set you up for the next couple of months to 3 months. And this is going to likely lead to some very easy 5 to 10 X's. I'm trying to set you guys up here. So listen, okay? So the fourth part of this playbook is for a range breakout or liquidity sweep leading to. So once you go from low volatility, guess what comes after? Well, high volatility, which means that there are only two ways for things to play out. One is that you break out of the range and you want to buy the retest, right? So currently Solana is one of the first ones to be doing this. For example, ENS hasn't really quite broken out yet. Pendle not quite broken out yet, which means you're not too late. But what you want to look for, break out above the range, right? It should be very clearly defined what the range looks like. Breakout, retest, and then boom, right? That's going to be your entry right here. This is your entry. So going back to Solana, the playbook is going to be pretty simple. this is your previous, quote unquote resistance. So once you break out of the range, look for a retracement back into the $200 line, and that's where you want to be getting into. Ideally, you can also go into the 4-hourly chart and try to refine this down into just like higher probability areas. Alternatively, you can also go into lower time frames such as the 4-hourly chart or the 1-hourly chart to try to identify, get a better entry. Instead of like coming in here, you can perhaps come into here, and maybe instead of setting your stop loss all the way down here, you can set it down here. So just to show you what kind of a difference this makes, just going onto a lower time frame to just find a more refined entry. This is entry number 1 if you were to purely take it from the daily chart, and this would be entry number 2 if you purely, or rather if you refine it down to the 4-hourly chart. It's quite literally the difference between 2.35R and 5.5R. That's more than 2.5 times the difference of final profit that you get back. So if this trade were to net you $10,000, at the end of it, you're very likely going to net about $25,000 instead. Of course, you can, like, if you're not starting out with a lot of money, just extrapolate this for a bit. There is the law of compound interest, which means that the first few times you do this, you're not going to see a huge, difference, right? It goes from $1 to profit to like $2.50 profit. But guess what happens when you do this, 10, 20 times repeatedly? That number adds up a lot. So that's setup number 1, which is to wait for a breakout of the range into a retest, and ideally your stop loss should be somewhere within the range, because, well, guess what happens when you break out of the range? You're not supposed to, completely trade back into the range. If that happens, then your idea is invalidated, and so you just get out with a small loss, right? This is a calculated play. It's not a 100% play. It's, again, another misconception that a lot of beginners tend to have. Oh, AOC, you make these YouTube videos, but some of these things don't happen. Well, yeah, of course they don't. I can do this at a very high probability. I try to paint out every scenario for you, but it's not going to happen every single time because I don't have a crystal ball. Like, think about this for a moment. Steph Curry, who is the best shooter in the history of the NBA, quite literally the best shooter on the planet of a basketball, he makes his shots at about 45% from the 3-point line. That means that he's missing more than half the time in a game. And this guy is the best shooter. So like, yeah, he misses more than half the time. Yet, if you were his teammate, are you going to pass him the ball so that he can take a shot? Of course, because he shoots it at a rate much higher than anybody. Now, I'm not saying that I'm Steph Curry. In fact, I'm very far from that. But what's important to note is the principle behind what I'm trying to do here. Painting out different scenarios so that you guys are prepared for multiple scenarios instead of just saying like, hey, Bitcoin's going to go up. Cool. What if it doesn't? Then, you're screwed. What we try to do here is paint out multiple different scenarios. Anyways, going back into the original theory, which is that's the second setup, which is a liquidity sweep. So the second setup would be a liquidity sweep somewhere along the range lows. So whatever range that you draw out, you can draw out multiple liquidity lines. And again, for those of you who do not remember, liquidity is simply any sort of swing point that stands out to you. Now, these are all liquidity levels because they are previous swing lows. And the beautiful thing about, the swing lows and swing highs is that a lot of traders pool their liquidity around these levels. For example, if you were to go long here, where would you realistically set your stop loss? Guess what? It's at the liquidity level, right? At a previous swing low. This is what traders are taught to do. In fact, right now, even I am telling you to, like, if you want to trade, like the invalidation for a trade like this, for example, would be below a swing low. That's normal. But what's good to understand is that knowing that a lot of traders are going to have their stop losses underneath these levels means that once these levels gets taken out, everyone's going to be wiped clean. And that is going to become the fuel that the market needs in order to just pump straight up, which is why I say look for, like setup number 2 is to look for some kind of a liquidity sweep at around the range lows. Because again, a lot of stop losses here. Range lows means that every single one of these levels is going to get swept. Boom, you get the range low sweep. Boom, you buy here, let's say, or you buy when the price reclaims the range, meaning this is your range low. You want to wait for price to pump inside the range and to flip this potential resistance into support. So this is where you buy. You set your stop loss underneath the wick low here, right? The wick that just swept the liquidity, and then boom. That is one of the highest probability setups that you could possibly have in crypto or trading in general. If that happens, like, this is the playbook to get into 500 to 1000% gains on autopilot. This setup repeats at least twice a year, possibly 3 times. And if it's a really volatile year, such as back in 2021 or even back in 2018, especially 2018, this happens multiple times a year, up to 4 to 8 times a year. Last year, it happened about 3 times. This year, probably going to happen at around the same clip, 2 to 3 times. But whenever you get these opportunities, this is a easy way to multiply your money by about 3 to 5x. So if you do this 3 times, let's say you start with $10,000, like let's say you're not perfect, right? You don't get $30,000. Maybe you buy the wrong coin, right? Let's just attribute this to a little bit of beginners like ignorance and say that you only double your money. So even if you just double your money 3 times over the clip of the whole year, 10,000 turns into 20, 20 turns into 40, 40 turns into 80, right? That's if you underperform and if you don't know how to use this playbook. And this also assumes that you're not adding any money back into crypto as you get your paychecks and stuff. So quite easily, this is a brain dead framework, beginner friendly, that you can use to turn 10K into 100K in, well, the next year, essentially. And this is what I'm trying to set you up with, because right now it's seeming like this playbook is playing out and I don't want you guys to miss out on this opportunity, which is why I'm going to set you up with something even better in the next couple of weeks. I'm hosting a free masterclass on almost like a kickstart guide to help you turn 2025 into your best year in crypto. This is going to be especially helpful for those of you who were in crypto in 2024, but you did not get the results that you've seen other people get and you feel like you're lagging behind. 2025 is likely going to be the blow off top for crypto. We're entering the most parabolic phase of this cycle. And guys, I purely just want to set you up. There's no strings attached. This is not going to be some kind of free webinar where I spend half the time trying to sell you something. This is purely going to be me delivering a lot of value and ensuring that you start 2025 the right way, with not only my predictions for what coins are going to have the highest potential for gains. I'm going to set you up with my entry and exit models for bull runs, so you know exactly what to look for to get in and out, so that you actually walk away with your profits instead of just having it be on paper. And lastly, I'm going to give you a guide on how to allocate your portfolio the right way to maximize your gains and minimize your downside. This is not something that people discuss on YouTube. The last time we had a masterclass like this, we completely went over capacity, so we're going to limit it to just 500 people this time around. If you're interested, click the first link in the description box below. Again, no strings attached. It's completely free. It's going to happen in 2 weeks. And if you're part of the first 500 people, you're actually going to get a really nice bonus. Not going to spoil the surprise for you though, so sign up now and I'll see you guys at the masterclass. Bye-bye.